Good afternoon to everyone. This is Chandralekha from Syngene Investor Relations team, and I welcome you to Syngene International earnings call for third quarter and 9 months fiscal year 2018. To discuss our financial and business performance, outlook and address your queries, we have with us Mr. Jonathan Hunt, Syngene Chief Executive Officer, and the senior management team. I hope you have gone through our results release and quarterly investor presentation, which have been uploaded on our website as well as stock exchange website. Before we proceed with this call, I would like to remind everybody that this call is being recorded and a replay will be available for next few days immediately after the call. The transcript of this call will be made available in a week's time on the company's website. I would like to add that today's discussion may be forward-looking in nature and must be viewed in relation to risks pertaining to our business. The safe harbor clause indicated in our investor presentation also applies to this conference call. After the end of the call, if you have any further questions, please feel free to reach out to me. I will now hand over the call to Jonathan. Over to you, Jonathan.
Thanks, Chandralekha. And good afternoon, ladies and gentlemen. Thank you for joining us on this earnings call following the announcement of our third quarter results of FY18. I'll start with a high-level overview of our financial performance during the quarter before getting into the business performance. Mr. Chinappa, our CFO, will cover finer details of our financials in his comments. Now, I'm happy to report that the growth momentum of the last 2 quarters continued to pick up pace into and during the third quarter. Revenue grew 15% to 399 crore rupees, while on a year-to-year basis, our 9-month revenue was up 11% to 1,059 crore rupees. This is the third consecutive quarter of increasing growth and reflects strong fundamentals and I think a robust business model at Syngene. EBITDA for the quarter was up 8% to 138 crore, and at the PAT, or profit after tax line, was up 10% to 82 crore. So overall, it's good growth across all of the businesses. Our chemical development business within the development and manufacturing vertical continued to pick up pace, and we also saw good traction in our discovery services vertical. Good cost management, together with some fiscal benefits in terms of higher tax incentives, helped us deliver good profitability and good margins. And I know Chinny will give some more detail and some comments on that later. So let me turn now to key business and operational highlights as we see them in the quarter. So as you're no doubt aware, Syngene shared a long association with Bristol-Myers Squibb, starting all the way back in 1998. In 2007, we set up our first dedicated R&D center for BMS, and today that's the largest research facility for BMS outside of the USA. Now, I'm happy to update you that Syngene and BMS further consolidated this partnership during the quarter by expanding the scope as well as extending the duration of that collaboration. So under the changed agreement, Syngene will set up an additional new facility. We'll put a dedicated team of Syngene scientists within that and support the future R&D requirements of BMS. The duration of the collaboration also was extended, and that now runs to 2026, so it gives us very good long-term visibility. The collaboration with BMS really is a flagship relationship, and this expansion, I think, gives good validation to the exceptional quality of science that Syngene delivers to BMS to meet their R&D requirements. And it really is going to enable the two companies to collaborate ever more closely and across a wider range of scientific and research and development, really there with the aim to develop new drugs that will bring benefit and betterment of patient communities around the world. Also during the quarter, we entered into a multi-year development and manufacturing relationship with Zoetis. Zoetis, as I'm sure you know, is a global leader in animal health. They work on discovering, developing and manufacturing a diverse portfolio of animal health medicines and vaccines. And the agreement includes research and development activities, but also provides for development and commercial scale manufacturing. So let's turn and quickly look at future investments, CapEx projects and the like, and also update you on the S2 facility. So our new biologics manufacturing plant's now operational. It's a significant boost, I think, to our commercial scale biologics manufacturing capabilities and capacity. The plant comes with 3 state-of-the-art single-use bioreactors. Each one's got the capacity of 2,000 litres, and really is designed to both manufacture clinical as well as commercial batches for the global markets. The construction activities at our upcoming API manufacturing facility in Mangalore have commenced, and we expect that facility to be operational in FY20, which will significantly ramp up the commercial scale and manufacturing capacities within the organization. The S2 refurbishment activities are in full swing, and we're expecting that facility to be back in operation by the first quarter of the next financial year. And we've received 61 crore towards the second tranche of the insurance claim, and we continue to work closely with the insurance provider as we work towards final settlement of the full claim there. Switching on now to, say, the management side, we strengthened our global commercial leadership as well as the EHSS function. Ashu Tandon joins us as Chief Commercial Officer, and he's going to drive global commercial activities, which include business development, marketing, brand building, and customer relations and key account management. He's going to continue to be based out of the US, but has global responsibilities. In EHSS, Rajinder Patel joins us as head of EHSS, and he's going to take on driving various initiatives across the company to continue to maintain strong safety systems, strong safety processes across the organization. So with that, let me make some summary comments before I hand over to Chinny. Some of the key highlights of the quarter. Very pleased with the growth momentum. We saw that pick up throughout the quarter. Our business development activities are paying dividends, and we're engaging new customers, and we think that's a good signifier for the future, especially in the biologics segment. The commissioning of our new biologics manufacturing facility brings capacity that we need online, and the S2 facility is nearing completion, and that then will give some more headroom for growth in our discovery services segment. So overall, I see it as a good performance and a particularly good quarter. So with that, let me hand over to Mr. Chinappa, who's going to talk a little bit more detail around some of our financials.
Thanks, Jonathan. Hi, everyone. Let me give you a brief of the financial highlights for the quarter and the 9-month period. I will then cover the impact of the interest income, provide an update on the CAPEX program, the impact of the currency movement, and finally reprise you all on the FY18 directional outlook. Coming to the quarter results, we have registered a robust growth of 15% in Q3FY18 at 399 crores compared to 347 crores in the same quarter in the previous year. In constant currency terms, our revenue growth is 4% higher at 19%. The average realization against the US dollar was at 64.6 compared to an average of 67.3 in the same quarter in the previous year. EBITDA at 138 crores is up 8% as compared to 127 crores in Q3 FY17, while the profit after tax at 82 crores is up 10% as compared to 74 crores in the same quarter in the previous year. EBITDA and PAT margins for the quarter are at 34 and 21% respectively, compared to 37 and 21% in Q3 FY17. During the quarter, we had recorded an interest income of 11 crores, associated with the interest income of finance charges of 5 crores and income tax of rupees 4 crores. If we exclude the benefit of interest income, the revenue growth for the quarter is at 17%, adjusted EBITDA and PAT margin is at 33% and 20% respectively. Turning to the cost elements, our material and power costs as a percentage of revenues have marginally increased to 29% this quarter compared to 28% in Q3 FY17. This is largely owing to the sales mix and the pickup in chemical development revenues that Jonathan highlighted earlier. Employee costs as a percentage of revenues is up marginally at 24% compared to 23% in Q3 FY17. Other expenses for the quarter are up 25%. This is largely on account of the expansion of the facilities initiatives in business development, safety and compliance. We also had one-off costs associated with the expiry of the Abbott contract and the hedging gain of rupees 15 crores in the quarter. As you may be aware, we had a contract with Abbott Nutrition that had about 20 FTEs and represented about 1% of our total revenues. Last year, they extended the contract for a year and the same has expired as of December 2017. Moving to the 9-month performance, we have achieved 11% growth at 1,059 crores compared to 956 crores in the same period last year. I'd like to point out that this includes a benefit of rupees 65 crores from export incentive schemes. These benefits pertain to the period FY16, FY17 and the 9 months of FY18, all of which have been accounted in the current year based on the certainty of realization. This has helped neutralize the 4% impact of currency appreciation. EBITDA at 381 crores reflects 36% margins compared to 354 crores at the 37% margin in the same period last year. Profit after tax is at 221 crores compared to 209 crores in the 9 months of FY17. PAT margins at 21% against 22% last year. The effective tax rate for 9 months ended December 17 is at 18%. We will continue to benefit from the tax incentives applicable for SEZs. However, we expect to see an increase in tax rates from FY19 onwards as some of the units come off the tax holiday period. CapEx and balance sheet items. As regards CapEx, we have so far committed a total spend of 103 million against our ongoing 200 million CapEx program. This includes 72 million for expansion of facilities in Bangalore and another 31 million towards the upcoming commercial API manufacturing facility in Bangalore. I'm happy to share that the construction of the Bangalore site has commenced and we remain committed to commissioning the facility in FY 2020. The net cash position as of December 17 is 95 crores compared to 280 crores as of March 2017. As you're aware, we receive advance from some of our customers which should come in the month of January and increase the cash balance as of March 2018. Insurance. As regards the insurance claim related to the H2 facility, as Jonathan pointed out, we have received a second interim payment of 61 crores, taking the total insurance receipts to 81 crores. The balance insurance proceeds we expect to be realized along with the refurbishing of the facility, which is scheduled to be completed in Q1 of FY19. Forex. About 93% of our revenues are priced in US dollars and 3% in euros. While we have seen a strong appreciation of the rupee against the US dollar, our hedging policy has helped reverse the negative impact of the rupee appreciation and is further expected to protect margins in the near term. Lastly, as mentioned earlier, we expect to close FY18 with a strong growth momentum driven primarily by biologics. With this, I'd like to hand it over back to the operator and we'll be happy to take any questions.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. We take the first question from the line of Nitin Gosar from Invesco Mutual Fund. Please go ahead.
Hi, team, 2 questions. One is on the current quarter's number. The revenue seems to be around $60 million. Should this be the base going forward on quarterly basis? And number 2 question is with regard to other operating income or the export incentives. If I heard it right, it is accumulation of FY 16, 17 and 9 months of 18 which got reported in this quarter number.
Thanks for that, Ratan. Chinny, if you want to take the second question, but I'll just give a comment on the first one. I'm almost tempted to say no, I hope not, in that, the bit we're trying to indicate on revenue is that we're seeing a good acceleration through the year. If you take it sequentially, the growth rate in the first quarter was 6%, second quarter was 10%, third quarter 15%. So, my expectation is we'll continue to grow as we go into future quarters, and my hope is that we continue to see some continuation of that trend. At the same time, we don't give forward-looking earnings guidance or revenue guidance. Just a general commentary on what we see as the drivers within the business. With the biologics capacity coming online this quarter, it has the opportunity starting from the fourth quarter and, of course, going into the next full fiscal, that it will be becoming a revenue-generating asset rather than a CapEx project. So that's another string to our bow, as it were. I think there's more than that. We're seeing broad, good performance across the business. We indicated there that we'd seen good pickup with ChemDev during the year, and particularly in the third quarter. Discovery services are doing well. Biology within that, the Discovery Biology Group, is one of those areas that I think there's a structural change going in globally amongst our clients' business, where there's more demand for expertise and services within biology. So it looks good. Good position. Happy with the progress we've made this quarter, and I think it indicates that we're on a good direction for future quarters. But as I said, we don't give particular earnings guidance. Chinny, do you want to talk a little bit about the moving parts on the export tax?
So, Nitin, these tax incentives are the incentives that will come through the foreign trade policy. Till 2015, these benefits are not applicable to special economic zones. These are only available for units operating in the domestic tariff area. However, to compensate exporters for the poor infrastructure, higher cost of credit, and the high incidence of taxes, these benefits have been rolled forward also for special economic zones, with effect from 2016. However, the procedures for claiming this money and the funding of it all of that was kind of uncertain. This year, we've been able to claim for FY16 and then later also filed and realized claims for FY17. Following the certainty of the benefits under the scheme, we have started to record the income this year. 65 crores is the total revenues recorded in the 9-month period. During the quarter, it is 20 crores.
Okay. Perfect, sir. Thank you.
Thank you. We take the next question from the line of Prakash Agarwal from Axis Capital. Please go ahead.
Thanks for the opportunity and congratulations on improving run rate. So a question on trying to understand the run rate Q&Q on revenue side and the cost side. So if you see the other expenses seem to be running faster. You did mention that you have commissioned this biologics plant. So, the understanding is correct that this is still to be revenue generating, and if yes, what is the, the ballpark kind of revenue generation estimate that we can assume given it's fully commissioned and operational?
Yeah. So I'll make some sort of broader strategic comments. Chinny, maybe you want to talk a little bit about the moving parts in the cost base during the year, during the quarter. I'm going to have to disappoint you, as I'll go back to the comment I made with the last question. Just as a matter of policy, we don't give line item forward-looking guidance. But I think the the most strategic bit, if you step back and look at where Syngene is as a business, is that we're simultaneously growing while building. And there's a lot of investment in new capabilities and capacities going in. Some of it is about strengthening systems. So, you've seen us talk during the year around our wish to continue to raise the standards at which we operate, to make sure that we're definitively world-class when we talk about quality, about safety, about the integrity of what we do. And I mentioned it in a number of the sort of media interviews earlier on today. There is only one standard at Syngene, and it's world-class. And we have to operate to that. And therefore, the state-of-the-art continues to evolve, and we have to keep pace with it, and we have a willingness to do that. So there's constant investment in making sure that we operate at those very best standards. By the way, that's visible in the marketplace, and that's why our customers will often uniquely consider Syngene as a vendor of choice if they're coming into India, because while we are Indian in our heart and our soul, we operate at world-class standards. So there's that constant need in terms of investment. I think the second bit is just around expansion about what we do. We're not the same business we were 5 years ago. We're much broader based than we were with what was predominantly, say, discovery chemistry and chem dev focused organization. We've built a depth of talent in biology. We've grown in those other areas, by the way. That's not to say that they're not strategically important, but we've added biology to it. We've added a whole number of other capabilities. And you'll see us continue to invest. At the same time, we've seen some pretty good revenue performance. So it's a little bit like building a better plane while flying it. You don't get to stop, and we're trying to keep that momentum going. Hopefully that gives you a sense of the strategic framework I'm putting on it. Chini, do you want to talk a little bit about the nuts and bolts and the moving parts?
If we look at the quarter, total other expenses is about 52 crores. Just as I said, it's net of 15 crores of hedging gains. So if we add back the hedging gains, we're looking at 67 crore other expenses as compared to 42 crores last year. Last year we did not have any, we had about 40 lakhs of hedging gains. So the cost increase is really 42 to 67, which is a 25 crore cost increase. I would split this into three parts, roughly a third each. 1/3 is associated with some one-time costs associated with the expiry of the Abbott contract. 1/3 would be linked to expansion of our facilities as we ramp up. And another third is, as Jonathan mentioned, is towards the initiatives around strengthening business development, safety, compliance.
Understood. And just to reconfirm, this expansion of facilities, especially the biologics, is it started to generate revenues, or in future quarters we'll start seeing that?
It has started to generate revenues, but most of the projects will be completed. It started last quarter. Most of the projects will be looking for completion in this quarter. So the higher impact of the new facilities will be reflected truly in Q4.
Understood. But to paraphrase that, Chili, the revenue driver from that new biologics capacity won't really start to have an influence on the P&L until next quarter at the soonest. And then they've got a long way to go. I mean, they've got to build a business with brand new state-of-the-art facilities. So we're only just operational is the point there.
Yeah, so I mean, just last question here, just a follow-up on this. I'm trying to understand the the consolidated operating margins, EBITDA margins. So I mean, the little pressure that we see is more of a timing issue, because few of the facilities are yet to be fully operational and revenue generating. So once that comes in, we'll be back to over 33-34% EBITDA margin is what I'm trying to understand.
Well, the EBITDA margin for the quarter was 34. That's correct, Chili.
Yeah, so so we do, I mean the street does excluding other income, so we are talking the operational margins, which is so 32 is what I'm trying to understand.
Roughly 33%, and
So there will be some operating leverage is what I'm trying to understand. If a little more color could be given, that would be very helpful.
Well, I actually think the premise of your question is about right, and it's in line with comments that we've made in the past. A business like ours, with the mix that we've got of skills and capabilities and differentiation, EBITDA margins in the low 30s is a strong performance. Once you're drifting up beyond sort of 32, 33, 34, then you're starting to get into very strong performance. We're capable of doing both of those, but a normal, through a business cycle, through an investment cycle, which is, we see that as multiple years, that feels like a good benchmark, certainly into the low 30s. And then similarly, where we currently are on tax, that sort of leaves you with high teens, 20s as a PAT margin that looks solid and sustainable through a business cycle. And interacting with most of you in terms of the analyst community, that seems to be the benchmark that you use when thinking about Syngene.
Sure, thanks. I'll join back.
Thank you. We take the next question from the line of Nishant Chandra from Temasek. Please go ahead.
Yeah, hi. So, Chinni, on this accounting of this export incentives, is it all booked in Q3 or is it evenly spread out over the 3 quarters?
Yeah, 65 crores in the 9-month period, 20 crores in Q3.
20 crores in Q3. And why is it actually phased, given that it's an element of catch-up? Why is it actually phased across the 3 quarters?
I mean, it's linked to each year's incentives. So in the Q1, we actually received we filed and received the benefit for FY16.
Oh, okay.
FY17 rates were not notified till that time.
Got it.
In Q2, we got the FY17 rates notified. We filed the claim and accounted in Q2.
Oh, okay, got it.
And then FY18 rates got notified in Q3.
Okay, understood. The second one is on the hedging. So I understand that we do like a portfolio hedging of sorts, trying to match revenue profiles and the hedging profile. So currently, I had 2 questions in this one. Currently, what would be the, let's say, percentage of notional hedge that we have outstanding, to the extent of, any color that you can give around percentage of revenue, run rate covered, or anything to sort of quantify that? And second thing is, from a contract renegotiation principles perspective, our costs are primarily in rupee, and hence on the incremental renegotiations, are we able to pass through this element of dollar movement, effectively INR appreciation to our customers? Just directionally would be fine, just to get some color on what's happening in the business.
Yeah, the hedging policy is around protecting us for about 100% of our net year 1 exposure, 70% of our net year 2 exposure, and 100% of our long-term fixed price contracts. So that's how we go about the hedging.
Okay.
I think this has been consistent over the last 10 years. So that really gives us a near-term protection and then gives us a window to start discussing with clients and looking at opportunities to deal with any appreciation of the rupee, if we can either improve efficiencies, cut costs, or increase billing rates.
Correct.
To deal with rupee appreciation. Typically, there is a lag between the currency movement and the point at which you can negotiate with the customers, because you can't keep going back to them quarter on quarter.
Correct.
So if just rupee appreciation can persist, that will be another point of discussion as we negotiate with the client.
And just to maybe put a bit of a flavor around that, Chinni, our history, particularly with some of our larger and long-term strategic clients, is that they take a very pragmatic view around that. When they've seen a period of dollar appreciation, rupee depreciation, and they've understood the economic impact that has on us and on them. They've been pragmatic around it. I'd expect them to be similarly pragmatic if the same thing happens in reverse. Because ultimately, what they're looking for is value creation in their own businesses through excellent science and innovation. And they're not looking to do that purely through FX translational effect. It's about innovation and science, where the real super returns and value creation is in dealing with an organization like Syngene and the work that we can do for them. So tends to be quite a pragmatic and I think well-balanced discussion of those things. But let's see, because none of us are going to be able to call the currency markets with perfect foresight in any given future period.
Okay. Yeah, so, just to sort of put some context to my question. So the last year or so has seen a reasonably large magnitude appreciation of the rupee. And it sort of persisted for a while to the extent that I don't know if it's been brought up during the current round of negotiations, especially in the non-long-term customers, because long-term in any case we are covered. Only those which are coming up for renewals or let's say newer contracts with the same existing bunch of customers where we would have this principle of FX cost or FX movement coming into the negotiation table. So I was wondering if it has been discussed at this stage, or we still feel that it's still too early and hence we're just holding it back till it becomes far more structural adjustment that we see on FX.
I think it's elements of both, which is that it's not a new issue to have in things that you need to agree. If you're pricing, as we do, nearly all but not quite all of our contracts in dollars and we operate in rupees, it's just a standard bit of every discussion. It's not got to the point yet where it's either a bone of contention with our clients or an unmanageable pain point for us. And ultimately, those discussions are grounded in tell me about how you're going to innovate and what the great science is that you're going to do, and increasingly less in what's the translational dollar cost and a price point. We're an added value service provider in the main, not necessarily just the cheapest scientific solution in town.
Got it. And John, just to this will be my last question, just to sort of get some perspective around points of engagement with your clients. Is the ultimate decision maker the R&D team, or is it and it goes to the CFO's office for just a practical sign-off and housekeeping, or do you face two negotiation teams, one for scope with the research team and the second on the commercials with the, let's say, the finance team or the CFO's office?
Oh, I love the binary simplicity of the picture you paint. I think it's much more complex than that. You're going to have the operational scientists, you're going to have the R&D leadership, you're going to have the CFO and the finance team. You've missed procurement out. In many big organizations, they're now either a heavy hand on the tiller or a strategic partner, depending on the line they take. So it can be more complex than that. But in the main, it works.
Got it. Okay. Understood. Okay. I don't have any other questions. Thanks a lot.
Thank you. We take the next question from the line of Paresh Dave from SBI Cap Securities. Please go ahead.
Thanks. Good afternoon. First question, extending on the EBITDA margin question which was asked earlier, is there scope for margin expansion through the biologic facility, in the sense that is biologic actually a higher margin potential for us, wherein it could lead to some kind of a margin expansion?
Chini, I struggle to hear that. Did you get the question?
Commissioning of the biologics facility help expand margin.
Okay, so in a way, the question was, will I give you forward-looking guidance on revenue and margins?
Actually not. I'm trying to get an indication as to, is this a better business, better profitable business?
Okay, if we can, and we'll discuss in abstract terms and directions rather than particular numbers. Yeah, but in general, there's a couple of things that I think will be obvious to you, which is that, biologics, I think, can be a good business. We've only just put new capacity in, so things like asset utilization curves, getting the maximum return out of the asset you've got. we're nowhere near that yet because we're on day one. We've only just brought that infrastructure online. So that's going to take a period of time. And, I think about a management period of time rather than a city quarter is the way you need to think about it. It's not going to happen overnight. Second thing is the manufacturing businesses compared to, say, FTE or even fee-for-service type work have scale efficiencies. You can, if you build a factory, you can drive up your utilization and your efficiencies. So I think it's prospectively a good margin business. But let's go and win those relationships, bring the business in, and then you'll see it in the P&L. Yeah. So lots more operational work and sales and business development to be done before you're going to be able to see that jumping out at you in the quarter's earnings and revenue.
Sure. Second question was with respect to the U.S. Is there any impact on the change in tax laws in the U.S.? I mean, will the companies who take services from us will be taxed higher for outsourcing the business? Any such indication?
No, I'm not aware of that as being an issue or even something that's on the agenda yet.
Okay. And the sub-part 2 is we have opened a new office in U.S. Is it more from the perspective of business development, or is there a scope for R&D as well?
No, I think in the first iteration of that, it's about being close to customer and convenient. It's about having great quality communication in your same time zone. It's about making sure that all of the science we do is easy for people to access because it's just down the street or around the corner, metaphorically. So yeah, primarily around that key account, key relationship building, and business development as well.
Sure. Thanks a lot. Have a nice day.
Thank you.
Thank you. Ladies and gentlemen, we take the last question from the line of Ashish Thakkar from Motilal Oswal Asset Management. Please go ahead.
Yeah, thanks for the opportunity. Jonathan, I would like to have your views on ADCs. Since you are working on ADCs, would it be safe to assume that you would also be working on the oral and the injectable side of the cancer treatment business?
Okay, so question about ADCs, where we're going with that. Let me bring Manoj Nirokar in, our Chief Operating Officer.
What was your second question about oral and injectable again? I couldn't connect that part.
Yeah, we wanted to know whether we are also working on the orals and the injectables side of the cancer treatment.
Yeah, we are. I mean, ADC business, as you know, is predominantly injectables, right? It's a intervention that's given as a parenteral or injectable drug. Having said that, the new formulation facility that we just inaugurated a couple of quarters back does cater to oral solids business as well. So a lot of these novel drugs which require oral solids, tablets, capsules, powders, all those are developed and the clinical supplies are manufactured and supplied to a client for conducting clinical studies. So you bet. As far as the injectable is concerned, currently we are in a drug substance space, but also looking at what other opportunities are available on the injectable drug product side.
Yeah, with so much of action happening in the oncology space in the US, I just wanted to know whether we would have gotten inquiries from our clients for doing phase 3 studies directly in phase 3.
When you say phase 3 means clinical studies, is that what you are referring to?
Yes.
No, most of these clinical studies are actually global studies, and therefore they happen around the world in different countries. We being a clinical trial player only for India and India-specific studies, our business is limited to only this geography. So yes, we do some bit of phase 3 studies, but that's not predominant part of our clinical business.
Okay, got it. Thanks. And last one for Chini. Chini, you're saying that there would be increase in the tax rates. Any guidance on that?
This is complex too, I think, but my sense is it could be up 1 to 2% over the current year.
Oh, right. That's helpful. Thanks a lot and all the best.
Yeah.
Thank you. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to Ms. Chandralekha Nair for closing comments.
Thank you everyone for joining today's call. In case if you have any questions, please feel free to reach out to me. Thank you. Have a good evening.
Thank you very much.